Well, good evening, everybody. Welcome back to Strongman Personal Finance. We got a sponsored video today. That's right. And if you want a sponsored video, click the pinned comment below, send me $50, and I'll make a video about whatever you want me to. I don't do stock price predictions or stock valuations. In this sponsored video, which you should totally do, bro, we're going to check out Chegg Incorporated, basically the cheating software. This stock has been absolutely annihilated. And the reason this happened is because ChatGPT AI. So basically before ChatGPT, students would not want to study because, actually learning the material was hard. It's not fair. I shouldn't have to study when I could just Google stuff, right? And they turned to Chegg to basically cheat in all their online homework. Okay, this thing boomed in the pandemic because everybody was remote and they could just cheat. They could just copy. That's what Chegg is used for. It's used for cheating, basically. And the stock did great during the pandemic, and then ChatGPT came out. And with ChatGPT, you can ask ChatGPT questions. That's right, and it spits out answers really freaking fast. Chegg is in a lot of trouble, because all these new language learning models, whatever you freaking call them, are coming out, and they're probably better, and Chegg is just one small fry in a big world. Now, the other models are backed by big companies like Microsoft and Google. Chegg is just this tiny little blip, okay? So now they're freaking out, and they're trying to add, quote-unquote, AI to save themselves. Now, how bad is it? Well, it's officially a penny stock, okay? It's dropped 94% in the past 5 years. Generally, if you believe in efficient markets, the market's telling you something here, okay? The consensus of the market is that this company's in deep crap, okay? Stocks usually don't just go down for no freaking reason. So the market cap is $160 million on trailing revenue of $683 million with trailing net income of negative $626. I'm pretty sure this was because of an impairment charge. We'll see very shortly. Forward PE is 1.89, so it's a value play, right? Yeah. And we got a price target from analysts, completely outdated probably, of 5.53. Just right off the bat, okay? If you want to invest in something like this, the market's telling you this is highly speculative. Insanely small part of your portfolio, if you want to do it at all. An insanely small part of your portfolio. Okay, I'm talking about like me, $50. And even then, I mean, why do it if it's $50, okay? This ain't something you gamble your life savings on, okay? Now, let's go ahead and look at the historical financials. So, revenue was basically flatlined over the past couple of years. They're still churning a gross profit. They just barely generated operating income. This is profit before interest and taxes. And they had a massive impairment of goodwill. Of $440 million. What is goodwill? It's when a company buys another company for more than the fair value of its net assets. Let's say Coke buys Pepsi. And you value Pepsi's assets and liabilities, and the total value of Pepsi's assets and liabilities, all their factories and whatever they freaking do, okay? They make sugary garbage. And I think Pepsi has a ton of other businesses. I don't really know much about it, to be honest. But anyway, Pepsi's worth $200 billion, for example. Well, Coke might pay $300 billion for Pepsi. Why? Because Pepsi is more than just its current value of all its assets minus liabilities, okay? So when a company pays more than the fair value of the net assets of a business they're acquiring, there's this account that pops up on the assets section of the balance sheet called Goodwill. It's just a plug, okay? Because, you're probably, if you're buying a profitable business, you're going to pay more than just the assets, obviously, because the business has future cash flows. So when you acquire another company, you generally record Goodwill if you pay a lot. And if you then find out that the investment wasn't a bad or a good investment, and the future cash flows that you expected from this business don't materialize, you got to write down the goodwill. That's what happened here. So they had positive operating income, but they did a one-time, one-off, and they'll maybe do this in the future, impairment of goodwill from an acquisition. Okay, this is a very bad sign. This is the company saying the company that we acquired ain't going to be doing nearly as well as we thought it was. It ain't worth nearly what we thought. The company's telling you future cash flows will be much lower. It's like clearer than ever, okay? But it's a one-time charge. So, okay, let's look at free cash flow per share. Okay, they've just turned negative free cash flow per share. I guess we'll see why in a second. But, this company hasn't really been that it was profitable during the clown market, okay? And this is when everybody was at home cheating. And this company's had a lot of freaking issues, okay? You can clearly see after the clown market ended, they only posted like a couple quarters of profitability. Profit margin abysmal. That's because of the write-offs. And free cash flow. So basically, this was like every other freaking tech company where they were probably doing a lot of stock-based compensation. Shocker. So, operating cash flow has collapsed, okay? Capital expenditures have contracted. I thought they were investing in AI, bro. And, okay, just tiny issuances of common stock. So, if you look at the company from a fundamental perspective, it's trading below its book value. Okay, it's cheap, bro. So I could buy all the assets for 44 cents on the dollar. Net assets for 44 cents on the dollar. Well, number one, that's book value, not fair value. And number two, if a company's losing money hand over fist, or is expected to lose money hand over fist, yeah, it might trade below book value, okay? So these trailing metrics mean nothing because the market's looking into the future and ChatGPT is basically clapping their cheeks into the fifth dimension. So let's look at their most recent report, okay? Why can't I zoom in? This is so annoying. There we go. Okay, so I know they just got a new CEO and they've had people from the board step down. Okay, so they just got this new CEO, Nathan Schultz. Q2 has been transformational for Chegg. We're getting annihilated. Completing our restructure. Everybody's freaking leaving. Everybody's bailing out. I don't blame them. Outlining an exciting vision for the future and completing the rollout of conversational instruction capability and automated solutions just in time for back to school. I'm sure everybody's flocking back to Chegg when you have ChatGPT. If I was going to cheat, I'd rather use ChatGPT instead of some clown student that you can't even trust uploading answers. Okay, so they're doing what AI crap, basically. AI to save the world. Total net revenues decreased 11% year over year. That's pretty concerning, okay? Subscription revenues decreased 11% year over year. Gross margin, 72%. So they have a high gross margin at the top of the income statement. Wow. Net loss was $616 million. That's mostly because of the impairment. I think, $440 of that was the impairment, the write-down of the Goodwill. And if they didn't have the impairment, they would have had non-GAAP net income of $26 million. So they still would have been technically profitable, even though they're literally telling you there's a huge problem with future cash flows. And subscribers decreased 9%. Okay? This is a massively contracting business with not a lot of financial firepower that is going up against the likes of big tech. Business outlook. Third quarter 2024, total net revenues in the range of 133 to 135. Oh my God. Oh, so net revenues. So third quarter, I guess that's when is the third quarter? Be what? July, August, September? So I guess that's like the doldrums. I guess that's when people really aren't in school. What was the Q3 revenue last year? Okay, so we see Q3, it drops. Yeah, I mean, that makes sense because kids aren't in school. So they're projecting dropping from 157 in Q3 of last year down to 135 at the best. So, what is it? 157 minus 135. Oops, I screwed that up. 135 minus 157 divided by 157. So 14% decline. I do my math right? Yeah, roughly. So they're projecting a roughly 14% decline. So the collapse in revenue, year-over-year growth rate is accelerating, okay? And subscriptions are getting cut, obviously, because school's out. And gross margin is contracting. So here we have the CEO, blah, blah, blah. Basically, no, everybody's leaving our software because they're going to use other stuff. Got it. Okay. So the guy asked, Mr. Sponsor here, he asked if this company's going to survive. Well, overall, in the long run, it ain't looking too hot. Okay, if you're thinking this is like a swing trade, okay, then you could swing trade it. You could swing trade poopy fart coin. Okay, stocks can go anywhere in the short term, but in the long term, this business is being massively threatened by AI. So I mean, if you want to trade it, you do whatever you freaking want. I'd rather buy VT than this. I'll just be perfectly honest. Okay. So let's look at their balance sheet. This and the statement of cash flows. It's easier to see on here than stunk analysis. So they have $133 million of cash and $212 million of short-term investments. So that's a total combined highly liquid cash amount. I guess if we include receivables, $365 million of highly liquid cash, or cash equivalents. And then they have prepaid expenses of $30 million. So basically, they had $35 million of liquid cash, and they've got $485 million of short-term liabilities, of which $357 million is convertible senior notes. Uh-oh. So what are they gonna do? Are the holders gonna convert the notes, or are they gonna pay this off or refinance it? So this company's collapsing. Okay, if they refinance this debt, who's gonna what kind of terms are they gonna get on that? Okay, if this gets converted, it's probably gonna be a massive dilution event. $357 million of long-term debt is coming due in 12 months, and they have $350 million of cash equivalents, and they now have negative free cash flow. Okay, so that's not very good. That's very concerning. Okay, there's a chance they could go bankrupt. Okay, I'm just saying. Oh, okay, well, they have these long-term investments here. So I don't know what these are. I mean, we could see later in the report. If these are like long-term bonds, okay, maybe they could sell these and put it all in cash and, squeak by a little bit longer. But if these are like other companies that they purchased, they may have to divest. So potentially they could sell these. Okay, so that's a possibility. They could sell these to generate short-term liquidity to pay off their debt if they can't refinance it or if they don't get converted. And nobody wants to offer them new debt, which wouldn't be surprising. Okay, property, plant, equipment's gone down a little bit, depreciation. Goodwill, see the massive decline? Look at that massive freaking decline. Okay, from $631 million to $189 million. That's a very clear sign that they're not happy about the future. Intangible assets, massive reduction, probably a write-off. Okay, this is patents, trademarks, whatever, or potentially like capitalized software costs maybe. They wrote it down. They decreased its value on the balance sheet because basically it ain't worth as much as it was before. And then the rest is like deferred tax assets and leases. Okay, so we'll see what these long-term investments are. These could maybe keep them afloat if these were all like bonds they could sell. But overall, like their long-term isn't looking too hot. Okay. So let's see. So they have the big thing is they have $357 million of debt coming due in the next 12 months. They have an additional $243 million of long-term debt due outside of a year. I don't know how soon it's going to be due. But they have roughly $350 million of liquidity, or an additional $259 million if this is actually short-term invest or like bonds, cash equivalents, or whatever. So we'll see what that is shortly. But in the long run, this business is in massive trouble. Okay, so EPS, we know EPS is negative. Let's see. Weighted average shares. Wonder why that decreased. Wonder if they paid off debt, convertible debt. Let's see. Let's go look at the statement of cash flows. What do they do here? Let's see. Impairment expense, that's a non-cash expense. That's why they added it back. Yeah, they paid off debt. That's probably why they have the diluted shares outstanding is less. So, I mean, they still have positive cash flow. Okay? So, they have positive operating cash flow. So, for the last 6 months, they had positive operating cash flow of $67 million. And investments in property, plant, equipment of $45 million. But in the most recent quarter, I think they had negative free cash flow per share. So this is showing the 6 months ended June 30th, 2024. So in the last 3 months, I believe this is deteriorated to where they're producing negative free cash flow. So the 6 month looks better than the 3 month, which means it's deteriorating as time goes on. Okay. Proceeds from sale of strategic equity investment. Yeah, they're going to start selling these long-term investments to generate cash because they're going to go into negative free cash flow. I mean, look how much the operating cash flow has collapsed. It's collapsed by half. And this could get worse and worse and worse and worse. And if they start turning negative free or operating cash flow, yeah, it's inevitable. It's done. Unless they can at some point reverse it in the future. I want to see what those long-term investments are. They don't tell me. Well, that's freaking lame. So, yes, there is a chance if things deteriorate even more rapidly that they can go under within a year. It's possible. Okay? All depending on what these long-term investments are. But in the long run, yeah, I think they're done. Personally. I mean, is it worth the risk? You want to play around? Okay, who cares? But, like, you could buy VTI. You could buy VT. You could put money in your savings account. You could pay off some debt. Why speculate on this? Okay, there's a lot of concern here. They've already told you with the Goodwill Impairment that their future's collapsing. And, you know, while they have like a decent amount of liquidity now, it's going to massively decrease over time, I believe. And then, of course, their revenue's collapsing, and it's actually accelerating. Their collapse of their revenue is accelerating, even accounting for the third quarter not being as busy. This ain't good, okay? So let me know what you guys think. Do you guys think Chegg is going to survive? If you want a sponsored video, check out the pinned comment below. It's $50. Check out my book, Stop Being a Broke Loser. It's on Amazon. It's awesome and it's amazing. It's basically my life philosophy. And if you want one-on-one tutoring or you just want to talk to me, you want to be my friend for an hour, there's also a $75 an hour consultation fee where you can meet me, be my friend, okay, or talk about accounting or whatever. So that's it. Talk to you later. Cheers.